That one sentence just hit different, didn't it? The idea that the IRS already knows you own silver, that's the kind of claim that stops a silver stacker cold. And I get it. For a long time, the precious metals community operated on a simple belief: pay cash, keep it quiet, and nobody's the wiser. But that assumption was never fully accurate. And right now, in 2026, with silver trading above $80 an ounce and posting gains of nearly 180% in 12 months, with the IRS running more advanced data matching systems than ever before, that assumption is even less accurate than it used to be. But here's the thing nobody's actually breaking down for you. Yes, the IRS has visibility into certain silver transactions. What's also real is a very specific set of circumstances where no form gets filed, no dealer notification gets triggered, and no paper trail gets created. And those aren't loopholes. They aren't gray areas. They are the explicit, published rules of the Internal Revenue Code. Most silver investors don't know where those lines actually fall. Some assume everything is reportable and overpay. Others assume nothing is reportable and quietly break the law. Both mistakes cost you money. One of them can cost you your freedom. Today, JON AG is walking you through 5 categories of silver activity that do not trigger automatic IRS reporting. The exact thresholds that separate reportable from non-reportable transactions. Specific products that are exempt no matter how many you sell, and the one distinction every single silver investor must understand before they move a single ounce. I am not a CPA and I am not a tax attorney. This is education, not advice. Every rule I'm covering comes from published IRS guidance. Form 8300 instructions, Form 1099-B requirements, and verified reporting from Coinweek, CBS News, Yahoo Finance, the Scottsdale Mint, and Atlanta gold and coin buyers. Every threshold is documented. Every exemption is sourced. Let's separate the facts from the fear. Before I show you what you don't have to report, I need to make one distinction absolutely clear, because missing this is the single most common and most dangerous mistake in precious metals tax compliance. Reporting and taxation are not the same system. Let me say that one more time. Reporting is what a dealer tells the IRS. Taxation is what you owe the IRS. These are two completely separate things. A transaction can be non-reportable by the dealer and still be fully taxable to you. The absence of a 1099-B does not mean the absence of a tax obligation. If you sell silver at a profit, you owe capital gains tax on that profit, whether or not your dealer filed a single form. You report your gains on Schedule D of your federal return. You calculate the spread between your sale price and your cost basis, and you pay the collectibles rate, which caps at 28% for long-term holdings and can reach as high as 37% for short-term gains. This distinction is the foundation of everything I'm about to tell you. The 5 categories I'm covering are things the dealer does not report. They are not things you don't owe tax on. The moment you confuse non-reportable with non-taxable, you've crossed from tax efficiency into tax evasion, and those are very different places to stand. Now let's walk through what you are legally not required to report, starting with Category 1, ownership itself. This is the most fundamental point, and the one that generates the most unnecessary anxiety in this community. There is no federal requirement to disclose how much silver you own. There is no national precious metals registry in the United States. There's no annual filing, no threshold above which you must notify any government agency about your holdings. According to CBS News reporting from February 2016, there is no federal limit on how much silver any individual can legally own. You can hold 10 ounces, 10,000 ounces, or 100,000 ounces. The IRS does not require you to report any of it while you're holding it. A taxable event happens only when you sell. Until that moment, your silver is private property and there's no reporting obligation tied to simply owning it. Category 2. Small quantity sales that fall below the 1099-B thresholds. When you sell silver back to a dealer, That dealer is only required to file Form 1099-B when your transaction hits specific large volume thresholds, and those thresholds are both product-specific and quantity-specific. For silver bars and rounds, the dealer must file a 1099-B only when a single transaction totals 1,000 troy ounces or more, with each piece carrying a minimum fineness of 0.999. For 90% U.S. silver coins, the pre-1965 dimes, quarters, and halves, known as junk silver, reporting kicks in only when a single transaction exceeds $1,000 in face value. So if you sell 100 ounces of silver bars, no 1099-D is filed. 500 ounces? Still no filing. $800 in face value of junk silver? The dealer has no legal obligation to report it. Coinweek's February 2026 analysis actually indicates that recent guidance may eliminate 1099-B reporting for 90% silver coins entirely, and that bar reporting may now apply only to sales of 5 or more 1,000-ounce bars. For the average retail investor, these thresholds are essentially out of reach. But I have to repeat it one more time. Falling below these thresholds means the dealer doesn't report it. It does not mean you don't owe tax. If you sold at a profit, you must self-report the gain on your return. Category 3 is the one that matters most from a product-specific standpoint, and it's the rule most silver investors either don't know or misunderstand: the American Silver Eagle Exemption. American Silver Eagles are exempt from Form 1099-B dealer reporting regardless of the quantity sold. 10 eagles, 1,000 eagles, 10,000 eagles. The dealer is not required to file. This exemption is confirmed by the Scottsdale Mint, Atlanta Gold and Coin Buyers, Summit Metals, Coinweek, and Yahoo Finance. It exists because American Eagles were not included on the original IRS reportable items list created back in the 1980s, and U.S. coins minted after that list was established are not subject to those reporting requirements. The same exemption applies to American Gold Eagles, fractional gold coins, and certain foreign coins not specifically named on the IRS reportable items list. Now, let me be precise about what this exemption actually means. It means the dealer doesn't file a form. It does not mean the gain is tax-free. If you bought 500 American Silver Eagles at $25 each and sold them at $90 each, your $32,500 profit is fully taxable at the collectibles rate. The exemption gives you a privacy advantage in terms of dealer reporting. It gives you zero tax advantage. Your obligation to report the gain on Schedule D is completely unchanged. Category 4, non-cash payment methods. The second major reporting mechanism in precious metals is Form 8300, which applies to cash transactions exceeding $10,000. But the IRS definition of cash is narrower than most people assume, and understanding what does not count as cash is just as important as understanding what does. Personal checks drawn on your own bank account, wire transfers, ACH transfers, credit cards, debit cards, PayPal, Venmo, Zelle, Cash App, none of these are considered cash under Form 8300 rules. They do not trigger the $10,000 reporting threshold. If you sell $25,000 worth of silver to a dealer and receive payment by wire transfer, no Form 8300 is filed. The transaction is invisible to that reporting system because the payment method doesn't meet the IRS definition of cash. This is confirmed by Atlanta Gold and Coin Buyers, the Scottsdale Mint, Coinweek, and the IRS Form 8300 instructions themselves. Under those rules, cash means U.S. or foreign currency, cashier's checks, money orders, bank drafts, and traveler's checks. If any of those instruments are used and the total exceeds $10,000, the dealer must file. If the payment comes by personal check, wire, or any electronic transfer, no filing is required, regardless of the dollar amount. This isn't a workaround. It's not a loophole. It is the explicit published definition, right there in the IRS instructions. Category 5, private person-to-person sales. If you sell silver directly to another individual rather than to a licensed dealer, no Form 1099-B is triggered. Private transactions between individuals do not create automatic IRS reporting obligations for either party. According to CBS News, private silver sales between individuals generally don't generate automatic IRS reporting, but they still create taxable events you are required to disclose. Sell 200 ounces to your neighbor, and no dealer form gets filed because there's no dealer in the transaction. But the profit is still taxable. You are still required to report the capital gain. And the IRS has become increasingly capable of detecting unreported income through bank deposit monitoring and data matching systems. A large unexplained deposit can trigger inquiries whether or not a 1099-B was ever filed. Now that you understand the 5 categories of non-reportable activity, I need to tell you about the one thing that can transform legal privacy into a federal crime, and that word is structuring. Structuring means deliberately breaking a large transaction into multiple smaller ones, specifically to avoid tripping a reporting threshold. If you have $15,000 in silver to sell, and you intentionally split it into 2 separate $7,500 cash sales on different days, just to stay below the Form 8300 threshold, you have committed a federal offense. Structuring carries penalties of up to $250,000 in fines for individuals, $500,000 for corporations, and up to 5 years in federal prison. Those penalties apply even if you owe 0 taxes. The crime is the act of structuring itself, not the underlying tax liability. Dealers are trained to monitor for these patterns. They're required to file suspicious activity reports when they observe behavior that looks like it's designed to circumvent reporting thresholds. They can even voluntarily file Form 8300 for transactions below $10,000 if something seems off. And the IRS explicitly encourages that kind of voluntary reporting in the form's own instructions. The line between legal privacy and illegal structuring is intent. 2 separate purchases made on different days for genuine independent reasons, that's normal commerce. Deliberately chopping one transaction into pieces to fly under the threshold, that's structuring. Don't test that line. It is not worth it. Let me quickly break down 3 myths that are quietly creating real risk for silver investors. Myth 1. The $10,000 reporting threshold was lowered to $600 or $3,000. Coinweek published a thorough debunking of this claim in February 2026. The standard federal reporting threshold for cash transactions involving precious metals is still $10,000. The confusion comes from unrelated regulatory changes, proposed FinCEN rules for investment advisors, third-party payment network reporting, and Form 1099 adjustments, none of which apply to precious metals cash transactions. Myth 2. Junk silver is exempt from capital gains because it's legal tender. That's false. Pre-1965 U.S. silver coins are legal tender, but their melt value generates a taxable capital gain when you sell above your cost basis. Buy $1,000 face value for $15,000 and sell it for $60,000, and that $45,000 gain is fully taxable. Myth 3, and this is the most dangerous one: if no form is filed, no tax is owed. Dealer reporting and your personal tax obligation are entirely separate systems. You can complete a transaction that produces no 1099-B and no Form 8300 and still owe thousands of dollars in capital gains tax. If the IRS discovers unreported gains through an audit, bank record review, or data matching, you're looking at back taxes, penalties, interest, and potentially criminal exposure. Everything I've covered today comes down to one practice that separates protected investors from vulnerable ones: record keeping. Your cost basis is your legal defense against overpaying. And your cost basis isn't just the spot price you paid, it includes dealer premiums above spot, shipping costs, safe deposit box fees, insurance premiums, appraisal fees, every legitimate expense connected to acquiring and holding your silver. Every one of those costs increases your basis, and reduces your taxable gain. Without documentation, you can't prove your basis. And if you can't prove it, the IRS can assign a basis of 0, meaning your entire sale proceeds become taxable gain. Keep every purchase receipt, every dealer invoice, every shipping confirmation. Document the date, the product, the quantity, the price per ounce, including premium, and the total cost paid. Retain those records for at least 3 years after you file the return reporting the sale. That's the standard IRS audit statute of limitations, though some tax professionals recommend holding them even longer. For inherited silver, the cost basis is typically the fair market value on the date the original owner passed away. That's called a stepped-up basis, and it can dramatically reduce or completely eliminate capital gains if you sell shortly after inheriting. For gifted silver, the basis is generally the original owner's purchase price, not the value when you receive the gift. Hitting either of those rules wrong can cost you thousands. Let me bring this together for you. The IRS is not all-seeing. They don't have visibility into your safe. They don't know how many ounces you're holding. They don't receive automatic reports for most retail-sized silver transactions. But they're also not operating blind. They have Form 8300 for cash transactions over $10,000. They have Form 1099-D for large volume sales. They have bank deposit monitoring. They have data matching algorithms. And they have audit authority reaching 3 years back from the date you file. Your job is not to hide from the IRS. Your job is to understand exactly where those reporting lines are drawn, so you can operate confidently within your legal rights while meeting every obligation the law actually requires of you. You now know the 5 categories of non-reportable silver activity: ownership itself, small sales below threshold, American Silver Eagle exemptions, non-cash payment methods, and private person-to-person sales. All of them legal, all of them documented, all of them sourced. And you know the one absolute boundary you cannot cross: structuring, which takes legal privacy and turns it into a federal crime. The investors who actually build wealth in this space are not the ones trying to disappear. They're the ones who know the rules so thoroughly that they never overpay, never underreport, and never lose sleep wondering if they did it right. If this video cleared up a rule you were unsure about, pass it along to a stacker who's been running on rumors instead of facts. Subscribe and hit the bell. The next video breaks down the exact cost basis calculation for physical silver, line by line, from purchase to sale. JON AG out. Know the rules, keep the records, keep your silver.